Welcome to StokTok's deep dive into Viking Holdings. Viking Holdings is a global cruise line operator, one of the largest in the world, that designs, builds, and operates a fleet of modern cruise ships serving leisure travelers across the Caribbean, Alaska, Europe, and other key destinations. The company operates across multiple brands and generates revenue primarily from passenger ticket sales, onboard spending, and ancillary services. As of May 8th, the stock is trading at approximately $82.67, placing it near the middle of its 52-week range, which ran from $42.20 on the low end to $87 on the high end. Let's work through the fundamentals, scene by scene, starting with a quick business overview. Viking Holdings operates a premium leisure travel business model. The company builds and operates modern cruise vessels that carry passengers on multi-week itineraries. Revenue comes primarily from upfront ticket sales, which carry high gross margins in the 40% range, plus onboard spending on beverages, dining packages, shore excursions, and cabin upgrades. The competitive moat here rests on brand reputation, scale in shipyard relationships and construction, operational execution, and the ability to deploy modern, fuel-efficient vessels at premium price points. Travelers pay a premium for brand, itinerary quality, and ship newness. The company has demonstrated strong pricing power, and switching costs for loyal customers are meaningful. Our StokTok score for Viking Holdings is 50 out of 100, a hold signal, with valuation scoring 10 out of 20, financial health at 11 out of 20, profitability at 15 out of 20, growth at 12 out of 20, and smart money positioning at just 2 out of 20. That divergence, strong profitability and fundamentals, but weak valuation and institutional appetite, is the core tension we'll explore. Now, valuation. The question every investor has to answer: are you paying the right price? The stock trades at a trailing 12-month price-to-earnings ratio of 31.96 times, well above historical averages for mature travel operators, which typically command multiples in the 15 to 20 range. Forward price-to-earnings sits at 24.74 times, suggesting some earnings recovery anticipated by the market. The price-to-earnings growth ratio, or PEG, is showing 0.00, which reflects that earnings growth estimates are either negative or non-existent at the consensus level. A yellow flag in our view when valuing a cyclical business heading into uncertainty. On an enterprise value to EBITDA basis, EBITDA being earnings before interest, taxes, depreciation, and amortization, the stock trades at 22.29 times, which is expensive relative to peers and the sector average of 12 to 14 times. Price to sales is 5.85 times, again elevated. Our DCF valuation model, which projects future cash flows and discounts them to present value, suggests the stock is trading at a 0% margin of safety, meaning we view it as fairly valued to slightly premium relative to intrinsic value under base case assumptions. That said, Wall Street analysts have a consensus mean price target of $86, with a high target of $104 and a low of $69, derived from 19 analyst firms. That mean target implies roughly 4.5% upside from current levels. Taking both signals together, a reasonable fair value range in our view sits between $79 and $92, representing the upside and downside scenarios based on near-term cash flow visibility and longer-term growth assumptions. The latest quarterly results, reported approximately 50 weeks ago, showed an earnings per share miss narrowly beat at negative 0.24 cents versus an estimate of negative 0.27 cents, though revenue came in at $1.72 billion versus expectations of $6.5 billion. A significant variance that reflects the volatile, capacity-dependent nature of cruise scheduling. Operating income was $0.36 billion, and net income was $0.3 billion, yielding strong profitability despite the top-line miss. Year-over-year revenue declined 13.8%, reflecting post-pandemic normalization and capacity constraints in the industry. The next earnings date is May 14, 2026, with consensus expectations for negative 0.11 cents in earnings per share. That represents another near-term catalyst for volatility. Market sentiment around Viking Holdings leans bullish, with a constructive view from prominent market commentators suggesting investor consideration. However, sentiment is tempered by broader economic concerns regarding industrial decline and sectoral shifts, a reminder that travel is discretionary spending, vulnerable to consumer pullback. Our take on valuation is measured. The company is not cheap, but it is not egregiously expensive either. The stock warrants caution, given the cyclical nature of the business and the current multiple expansion. Moving to financial strength, how solid is the foundation? The Piotroski F-score, a 9-point checklist that evaluates profitability, capital structure, and operating efficiency, comes in at 8.0 out of 9. An excellent signal indicating no material red flags in the basic accounting health of the business. The Altman Z score, which estimates bankruptcy risk across 5 weighted metrics, sits at 2.31, placing the company in the gray zone. A Z score above 3 is typically considered safe. Between 1.8 and 3 is the gray zone where scrutiny is warranted. Below 1.8 signals higher distress risk. Viking is in that middle band, which means the balance sheet warrants close attention but does not scream insolvency. On the debt side, we see meaningful leverage. Debt-to-equity ratio is 5.25, extremely high, meaning the company carries $5.25 of debt for every dollar of shareholder equity. That is typical for capital-intensive businesses like cruise lines, which finance fleets through debt, but it does constrain financial flexibility. Cash-to-debt ratio is 0.64, meaning the company holds $0.64 in cash for every dollar of debt, a tight ratio that leaves little room for error during downturns. Interest coverage ratio is 4.4 times, meaning operating income covers interest expenses 4.4 times over. That is adequate but not comfortable. Ratios above 6 are preferred for cyclical businesses. Current ratio is 0.79, meaning current assets cover only $0.79 for every dollar of current liabilities, below the healthy threshold of 1.0. This signals potential near-term liquidity tightness if operating conditions deteriorate rapidly. The overall picture on financial strength is one of adequate profitability masking substantial leverage and liquidity constraints. The company is not in distress, but it is not fortress-like either. Management has limited cushion to absorb shocks, and that warrants caution in assessing downside scenarios. Next up, profitability. Is this business actually making money efficiently? Return on invested capital, or return on invested capital, sits at 11.88%, a respectable figure that indicates the business generates reasonable returns on the capital deployed in it. Return on invested capital above 10% is generally considered good for mature businesses. However, return on equity comes in at 342.48%, a figure that is artificially inflated by the high leverage we discussed, not a signal of operational excellence. The more meaningful metric is return on assets at 10.3%, which measures profit against total asset base and reflects genuine operational efficiency. Gross margin runs at 43.34%, solid for a travel and leisure operator, reflecting the pricing power Viking commands in the premium cruise market. Operating margin is 23.10%, excellent, showing that nearly a quarter of every revenue dollar translates to operating profit before financing costs. Net margin is 17.65%, strong, meaning the company keeps 17.65 cents of profit for every dollar of revenue after all expenses. Free cash flow margin is exceptionally high at 23.59%, meaning the company converts more than a fifth of revenue into cash available for debt repayment and reinvestment. The latest quarter showed strong profitability despite revenue headwinds, confirming that the business model generates substantial cash even during normalization periods. The profitability metrics across the board are healthy and support the thesis that this is a well-run, operationally efficient business. The constraint is not operational execution. It is the balance sheet leverage and market valuation overlaid on top of solid operations. Onto growth. Is this business expanding, and at what rate? 3-year revenue growth stands at 27%, a respectable expansion rate driven by post-pandemic demand recovery, new ship deployments, and pricing power. 5-year revenue growth shows 0%, meaning revenue is essentially flat over the longer horizon when normalized across the full cycle. This tells an important story. The company has recovered from pandemic lows and grown strongly in recent years. But on a 5-year basis, the growth runway is limited by the inherently cyclical nature of cruise travel and saturation in key markets. Book value growth over 3 years is 0%, indicating that shareholder equity has not expanded meaningfully, a direct result of the company returning cash to shareholders through buybacks and debt servicing, rather than reinvesting all earnings. The company currently does not pay a dividend, so dividend yield is 0%. Forward earnings estimates, as we noted, are negative to slightly positive, suggesting the market anticipates near-term revenue and earnings pressure. The thesis here is clear. Viking has recovered strongly from pandemic lows and enjoys solid near-term tailwinds. However, long-term growth prospects are moderate at best. The business is mature, cyclical, and operating near capacity utilization in peak seasons. Investors are not buying this stock for acceleration. They are buying it for current profitability, yield potential, and potential share buybacks funded by cash generation. The deceleration from 3-year to 5-year growth is a yellow flag for valuation at 32 times earnings. Growth multiples are justified by growth. Value multiples are justified by yield and valuation. Viking is priced somewhere in the middle, which creates tension in the thesis. Now let's talk smart money. What institutional capital is actually doing with this name? 6 top-tier investment gurus currently hold Viking Holdings in their portfolios, suggesting some sophisticated capital views this as interesting. However, and this is a critical but only 3.4% of 13F institutional filers are net buyers, meaning they are increasing positions in the stock. The threshold for net bullish institutional positioning is 50% of filers buying. At 3.4%, we have the vast majority of institutions either neutral or shrinking their exposure, which is a major red flag. Insider ownership stands at 0%, meaning management owns essentially no stock. This is concerning because it signals misalignment between management and shareholders. When executives have no skin in the game, their incentives diverge from those of long-term shareholders. Over the past 3 months, we see 0 insider buys and 3 insider sells, reinforcing this picture of management liquidating exposure rather than accumulating it. That is a bearish signal in our view. The smart money verdict is decidedly mixed to negative. Some institutional players see value, but the broad market positioning shows institutional money is either exiting or staying flat, not chasing this stock higher. The lack of insider enthusiasm is particularly telling. When you combine strong profitability and solid fundamentals with weak institutional buying and insider selling, you get a picture of a business that sophisticated capital views as fairly valued at best, overvalued at worst. That is precisely where the stock sits in the market. Smart money is not excited. And finally, the verdict. Let's bring it all together. On valuation, the stock is priced at a substantial premium to historical averages and sector peers, trading at 32 times earnings with limited margin of safety, and a fair value range between $79 and $92, implying roughly 0 to 12% upside from current levels. On financial strength, the balance sheet is adequate but leveraged, with tight liquidity and meaningful debt burden that constrains flexibility. On profitability, the business is genuinely well run, with operating margins above 20% and strong cash generation that support the leverage. On growth, near-term recovery is real, but long-term growth is moderate to flat, and the business is mature and cyclical. On smart money, institutional positioning is negative, with minimal buying and insider selling signaling lack of conviction from informed stakeholders. In our view, A fair value range for Viking Holdings sits between $79 and $92, representing roughly 0 to 12% upside from current levels. The latest quarterly results, reported approximately 50 weeks ago, confirmed that the company remains profitable and cash generative despite revenue pressure, a sign that operational quality is intact, but growth remains constrained. Our thesis is this: Viking Holdings is a profitable, well-operated cruise line with solid current cash generation and near-term pricing power. However, the stock is not cheap. At 32 times trailing earnings with limited long-term growth, high leverage, and weak institutional positioning, the setup looks balanced at best. This warrants caution in our opinion. The company has fundamental merit, the business is real, the margins are genuine, and management executes well. But the margin of safety has eroded. We would want to see either a meaningful pullback in the stock price to create a margin of safety of 10 to 15%, or evidence of accelerating long-term growth and margin expansion before becoming constructive. For now, hold is our stance. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Viking Holdings. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.